Suspended animation as the world puts aside issues of inflation and earnings and Fed policy and even COVID for a week consumed with war in Ukraine. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on the effect of the war in Ukraine on economics worldwide.
We are in a very different world than many of us had thought we were headed into.
And Deborah Lehr of Edelman on not letting Ukraine distract us from the second largest economy in the world, China.
If you look at the numbers, it's unbelievable. They had an absolute banner year when it came to production and when it came to exports.
This week, there was plenty going on, from the price of oil, as Dan Yergin of IHS Markit discussed.
Some say we're going to have over $100 oil for much of the year.
To what Jeffrey Yu of BNY Mellon says is the central bank's concern about inflation expectations becoming unanchored.
This strikes at the heart of what central bankers are worried about right now, as in a de-anchoring of inflation expectations.
But despite all that was happening around us, we spent the week focused on the geopolitical crisis in Ukraine, as President Putin recognized what purported to be independent republics in the eastern part of the country. The West imposed limited sanctions in response.
I'm going to begin to impose sanctions in response far beyond the steps we and our allies and partners implemented in 2014.
And then on Thursday, Russia did what the United States had been warning about. It launched a full-scale invasion of Ukraine, triggering much broader sanctions from the West and plunging Europe into the largest armed conflict in decades.
He has much larger ambitions in Ukraine. He wants to, in fact, reestablish the former Soviet Union.
For an update on the situation in Ukraine, we now go to our Washington correspondent. She's Anne-Marie Hordern at the White House. So, Anne-Marie, give us the latest on where we are from Washington's point of view in Ukraine.
Well, David, on the diplomacy front, we have the United Nations having a discussion about the resolution of condemning Russia for this invasion, and Russia has vetoed that. And also interesting, China has decided to abstain from that vote. So that's on the diplomacy front. And then, of course, there's the penalties that the West is imposing on Russia. And we have the United States joining the United Kingdom and the European Union on targeting President Putin himself, as well as the U.S. announcing they're going to target Sergei Lavrov, his foreign minister. Now, David, this is largely symbolic, especially for President Vladimir Putin. Officially, he has very little assets, according to his financial disclosures, making about $120,000 US a year. But this is something that can ratchet up the temperature because he joins a list of infamous leaders like Bashar al-Assad from Syria. And then, of course, David, there's the financial sanctions we had from this week on the big banks in Russia, most notably the two biggest financial systems of VTB and Sberbank.
Okay, thank you so much for your reporting throughout the week. That's Anne-Marie Hordern, our Washington correspondent. For her sense of where this crisis is headed, we turn now to Jane Harman. She's president emerita of the Wilson Center, and she's the author of Insanity Defense, about foreign policy for the United States. Jane, thank you so much for being with us. What is your initial take? We have a lot of developments yet to come, but as of right now, where do you think this is unfolding?
Well, let me say that the book you just plugged, thank you, David, for always doing that, makes the point that when the Cold War ended, we had no strategy for what the world would look like. We thought we won, Russia lost, and everybody wants to be us. Well, oops, we missed the rise of terrorism. We missed the rise of China, which doesn't want to be us. And we missed the sense of huge grievance that Vladimir Putin is now following through with by Russia, which did lose. But unlike World War II, where we helped those we conquered become allies and friends, Germany and Japan, this time we just rubbed Russia's nose in it. And so we're now paying a penalty for all three things. What do I think is going to happen? It looks pretty certain that Putin has outgunned, outclassed the fight of Ukrainians. And in some way, in the next few days, there'll be some bad resolution in Ukraine. I just hope that the courageous leader there, Zelensky, who has shown so much fight and so much bravery, unlike Ghani in Afghanistan, who escaped the country before it fell, will be safe. I hope he will be safe. But I don't think this is where it stops. I think the ambitions of Putin, maybe we should give him a red hat that says make Russia great again, are way beyond this. And he's trying to take down the liberal world order that we formed after 1945 and take advantage of the fact that there is still some disagreement among Europeans and European institutions and us. I commend President Biden for lashing us up to partners and allies and doing with them everything that's doable. And I do think there will be more sanctions by all of them and us, both on individuals and on banks and institutions. And those sanctions will bite. I don't want them to bite the Russian people. I really want them to bite Putin and the kleptocrats who are doing this.
Jane, you mentioned Afghanistan in a more recent time, but let's go back a little bit with Afghanistan, because Russia went into Afghanistan at one point. They spent quite a few years in there, and it came to tears in the end. Do we have any sense, do you have any sense at this point, of the likelihood that, in fact, Russia will simply be able to make Ukraine a vassal state, and that's done with, or they could have a protracted conflict the way they did in Afghanistan?
I think this could be even worse than Afghanistan. I was on the Maidan, that's the square in Ukraine, in Kyiv, in 2014, looking at the little memorials that were put up to the folks who gave their lives to topple this Russian puppet, Yanukovych. And that led to free and fair elections, first of Poroshenko, who's there in Ukraine right now, strapping on his weapon, and then following him to Zelensky. And so Ukraine has been a Western free democracy for 7+ years, even with Russian interference in the eastern part, the Donbass. And I don't think these folks are going away or giving up. And I think this is going to be an ugly story if Russia tries to occupy the country. And I don't think Ukraine is going to surrender easily. And this is not going to be, just not going to be a cakewalk for Russia.
Jane, let me double back on something you said, that you thought that this one was not necessarily the end from President Putin's point of view of where he wants to go. That's something that certainly President Biden said this week. So how nervous does President Putin have to be about triggering that Article 5 of NATO if it goes into places like Poland, for example?
Well, it's interesting. NATO has only invoked Article 5 once, and that was after 9/11. We didn't ask for it. Nick Burns, this mutual friend of ours, David, who is going to represent us in China, was then the ambassador to NATO. And they didn't ask us. They just invoked Article 5 to come to our defense after 9/11. Since then, it's never been invoked. But you're right. Poland is a NATO country. We're sending additional troops, and the whole complement of NATO troops is increasing. But the other worry is the Baltics, the Estonia, Latvia, and so forth, who are extremely vulnerable and small. And a question comes up about a cyber attack, a massive cyber attack. That was in the last block on your show. And that is certainly in Putin's playbook. And if he does something massive, let's imagine, that tries to take down the electric grid in Ukraine, and that spills over to Poland, could happen. Cyber doesn't know national boundaries. And then there's a massive cyber attack in Poland. Will that trigger Article 5? No one contemplated cyber among the forms of attack when Article 5 was enacted. So, I think we can't blink. I think this guy is trying to remake Europe, and I think the toughest response together with our allies and partners in Europe is what we have to do.
Yeah, there are so many things that I think people didn't contemplate at this point. Thank you so much, Jane. Really wonderful to have you with us. Jane Harman, she's President Emerita of the Wilson Center. When we come back, the market's response to the war in Ukraine with Kate Moore of BlackRock and Rebecca Patterson of Bridgewater Associates. This is Bloomberg Wall Street Week. I'm David Weston. This is Wall Street Week. I'm David Weston. Ukraine dominated a tumultuous week of trading, with the S&P 500 falling into correction territory on Thursday, only to climb back up 2.2% for the week. The Nasdaq was up also by 1.6%, while the 10-year veered from a yield of under 1.85 to over 2.0, ending the week just under the 2.0 mark. And oil, of course, got hit the most by the uncertainty over Ukraine. Brent shot up to over $105 a barrel after news of the invasion hit on Thursday, and then settled back down to $98 a barrel when it appeared that sanctions wouldn't hit the energy sector as hard as was thought, at least for now. To help us understand the market reactions, welcome now Kate Moore. She's head of Thematic Strategies at BlackRock Financial Management, and Rebecca Patterson, Bridgewater Director of Investment Research. So, Rebecca, both of you, welcome. It's great to have you.
Thank you.
Let me start with you, Rebecca. What about what happened with equities this week? It was all over the place.
Well, obviously we were all focused on the Ukraine and what was happening there, but I think it's important to remember that the markets are always being driven by a myriad of factors. Ukraine was front and center, but we also were in a period where we had a lot of buybacks going on. A lot of those tech companies that had sold off a lot probably benefited from that as we got into the end of the week. And of course, we're going into month-end rebalancing. And so that can also cause a lot of trading. So even when things are very whippy, and you don't always say, how does this tie to the headlines with Ukraine? It's important to remember that there's a lot of things going on behind the scenes in addition to that. Obviously, that was the most important thing. And as you said, the possibility that sanctions won't be as hard as they might be, at least for now, might have also helped us get a little bit of a reprieve towards the end of the week.
Kate, I know you're very interested in resources companies. What happened with resources companies?
We actually had a phenomenal week once again for resources companies. In the U.S., the XME, which is the S&P 500 mining ETF, hit a 10-year high today. And globally, we've seen the same kind of thing across resources companies. It has been a phenomenal rally driven by both good supply-demand dynamics as well as some concern over ongoing supply disruptions, particularly from the Russia-Ukraine situation. So you have both the geopolitical and the fundamental side really backing up an incredibly strong rally in a sector, when you think about the miners in particular, that have been so unloved for so long. It was a place I played in many parts of my career. I had to dust off some of my playbooks and some of my skills there.
One thing I'd add to what Kate just said on some of these resource companies is even before Ukraine and the threat to supplies that implies, we already had a situation where demand obviously very, very strong with all the fiscal and monetary stimulus after COVID. But then on top of that, a lot of these sectors had seen underinvestment for years. So supplies were already somewhat low before we had this demand shock. And now we're in a situation where supplies aren't even close to what we need, whether we're talking about oil with underinvestment both in the U.S. and by OPEC countries, whether we're talking about a lot of crops. We've seen underinvestment the last couple of years, partly a weather situation, but supplies very low, and in the metals. And so demand is improving after Omicron starting to fade. Hopefully, the Ukraine situation won't dent that too much. So you have strong demand and these supplies that can't keep up, and this just creates an additional risk on supply. So I think to Kate's point, some of these companies look like a good inflation hedge, and they're also just in a great position to benefit from that increased demand.
Yeah, and I would add on to something else Rebecca's saying, which is in addition to what's happening in the very near term around supply demand, there's also a longer term demand story. A lot of these miners produce metals that are actually incredibly important for the energy transition and for electric vehicles. And we're seeing them undersupplied in the market. We've also seen like some metals like aluminum, for example, or some resources like aluminum, have kind of a bit of a backlash against, how some of the that is produced. And so aluminum producers that use natural gas or cleaner energy to produce are coming into favor. It is a place where I think we'll see continued support for prices over the medium term.
Rebecca, this is a geopolitical crisis with a specific location, which is Europe. And we saw at various times this week a really different reaction in the markets depending on Europe versus the United States. Do you think that will persist?
Unfortunately, I do. We don't know the duration or the degree of the Ukraine crisis, and so obviously that matters. But even if there aren't the worst possible sanctions on energy, they want to get the energy flows to Europe. a third of Russians' oil exports go through the Ukraine. So if you have a situation where they can't get the flows through, you're going to see higher prices no matter what's going on with the sanctions. So what Europe's seen is greater risk of what I'd call a stagflationary shock, where inflation, which is already more than double the ECB, the European Central Bank's target, is going higher. And at the same time, growth is going lower. Part of it is a sentiment shock, but part of it is the inflation eroding people's disposable income. They just have less to spend. So the good news is that going into this shock, growth was improving. So they're starting from a strong place. The question is, how far does this pull them back? And then how does the European Central Bank respond? More to growth or more to the inflation? They're in a really difficult position.
Kate, I wonder about Europe in general, because before this all happened, there were those who were saying this was going to be the year for Europe. Finally, we're going to have the year for Europe because valuations were very attractive. There was going to be better growth. Does this change that dynamic, or did you believe in it to begin with?
Yeah, David, I never believed in it to begin with. And I think those folks that work with me know that, well, let's not call myself a Eurosceptic, but someone who doesn't believe that buying European index exposure makes sense in most scenarios. When you buy Europe, you get a lot of exposure to what I would consider lower quality, lower growth companies, a big exposure to the banks, big exposure to some companies that I would think of as having more stagnant business models and don't have kind of dynamic flow. So it was not something I was really excited about to begin with. And I think one of the things that's not fully priced into European equities right now is the extent to which this Russia-Ukraine conflict could bleed through into European growth. I think it's incredibly important to be selective in your European investments at this point. There are plenty of great high-quality companies that are not just going to be geared towards domestic growth. And I think that's where we need to focus our attention when we think about exposure to the region.
One thing I'd add to your point, Kate, if we're looking for catalysts that could affect our outlook on growth in Europe, would be what happens fiscally. So Europe is getting its act together this year. They're all talking about what should our fiscal framework be, their fiscal policy. Right now, they're set to start imposing their old policies, pre-pandemic policies next year. But they may decide, because of the Russia-Ukraine conflict, to give another extension. So letting governments spend a little bit longer, not putting that austerity straitjacket back on. If they do that, that could be another support to growth that I don't think is discounted in prices right now. We should know that around mid-year. So in addition to what the European Central Bank does, how they respond, this would be another important catalyst that I think could affect views. Again, I agree with you, Kate, certain stocks more than others.
So I'm happy to say that Kate Moore of BlackRock, as well as Rebecca Patterson of Bridgewater, will be staying with us as we turn from what happened specifically this week with Ukraine to broader issues that were here before Ukraine may last a long time after that. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Ukraine may have been top of mind this week, but the things investors were focused on last week are still with us. And for some of those things, maybe even more so. Still with us are Rebecca Patterson of Bridgewater and Kate Moore of BlackRock. So let's think all the way back to last week, Kate, if we could. We were worried about inflation, what the Fed would do. What about those issues?
Yeah, I think there were a couple of things on investors' mind before we got to this geopolitical risk. Number one, as you mentioned, was inflation, particularly what was that going to do to margins? We got some good news as companies came through earnings, but it's something we're really going to be watching in coming quarters. The second was, how do companies navigate supply chain challenges? And I think that question is now even more in the air with some of the geopolitical disturbances we may see over the next couple of quarters. And the third, I think, and most important thing is how do companies react to higher rates and a change in monetary policy. We certainly saw a lot of technology stocks de-rate, have their multiples come down as a result of higher rate environment. So these were the three major issues. I don't think they're out of investors' minds, and I think Rebecca did a great job at the top of the show talking about some of the other concerns we had even before this geopolitical issue.
And maybe just to keep going on the Fed, what's so interesting to me right now is when we think about the inflation data we got this week, core PCE, the Fed's preferred inflation measure, I think, up at 5.2%, highest we've seen since April 1983. And when we think about the Fed is expecting that it can get inflation back down to its target, 2%. in a little over a year with only interest rates going up to 2%. So 2 and 2, basically back to pre-pandemic trends within a year and a half from current levels. And if you think historically, how much has the Fed tightened in these cycles? Usually double what we're talking about this time. So can such a modest tightening get inflation back to where it was that quickly? And I just find that the risk is skewed that we're either going to see more tightening than what's priced in, or inflation is going to settle at a higher level than what the market is discounting. One of those two things is going to have to happen. I don't think the math works right now.
So let's talk some sectors or asset classes. Kate, I'll start with you. I know you're particularly interested in software companies, software as a service, those SaaS companies. How are they doing?
Yeah. It's been a really tough start to the year for SaaS companies, David. We've called it a SaaSacre a few times, where the stock prices of these high-growth software companies have really cratered. Some of that has to do with that multiple derating, the valuation compression that I think is coming on the back of expectations around monetary policy normalization. And some of it, I think, is because these stocks so meaningfully outperformed over the last 2 years that investors really rotated away from them and towards more cyclically sensitive and economically sensitive sectors. That said, many of these companies reported in the last couple of weeks and put up extremely strong numbers and raised guidance. So I would say this weakness, David, is an opportunity for us to take a better look at either some of the cloud-based software companies or the cybersecurity and software companies.
I hope you put a trademark on that SaaSacre. I hadn't heard that before. That sounds like a keeper there. You should keep that, Kate. That's pretty good. So, Rebecca, another asset class, crypto. Because it was thought that maybe people would go to it in times of risk. It's not clear that's happening.
Yeah, at the beginning of the pandemic, people were saying crypto, is it an alternative storehold of wealth? Is it an option on digital gold? And when we think about how it's been trading, and I'm going to use Bitcoin mainly since it's the biggest one, but Bitcoin has been trading much more like one of those tech stocks. So in January, for example, as people had increasing expectations for Fed tightening, liquidity going away, got absolutely hammered. And then just like we saw tech coming back this week, in the end of the week, so did crypto today. It had a bit of a recovery. But it's interesting to think, what is driving this new asset class? Is it really an alternative storehold of wealth, or is it a form of technology? What should you own it for? And for now, the jury's still out. It doesn't have a long track record, but it seems like if you're buying it as an inflation hedge, or if you're buying it for diversification, you just need to be careful because the correlations are certainly very, very fickle.
Yeah.
One really unfair question, but I have to ask. Kate, I'll ask it of you. As we look at Ukraine, we look at these basic backdrops that are still there. You look at Ukraine. Is it going to have a long-lasting effect, do you think, on the markets, or is it going to go away and we'll get back to where we were?
I mean, David, I got so many emails yesterday saying fade geopolitical risk, and everyone wanted to rush back into the market after their first few minutes of weakness. I think it's too soon to tell. As I was mentioning before when we were talking about Europe, the real question is going to be around the growth transmission and whether or not we end up seeing this geopolitical risk, really lead to slower growth in Europe and slower global growth. And if that ends up changing central bank calculus, or whether it's in Europe or in other countries, I think that's the thing to watch. It's frankly too soon to tell that we should, whether or not the weakness is very short-lived and we should just be buying dips.
I should give you a chance at the unfair question.
Well, I agree that it's too soon to tell. I mean, again, I go back to duration and degree. If this is a long conflict, it's more likely to have a greater impact on growth, especially if it turns into a conflict that requires greater sanctions that could affect energy supplies more. So I would watch those two things. How long does it go? How bad does it get? Policymakers are not in a good place. Even if growth slows with inflation at these levels, how much can they do?
Very quickly, Kate, is the one thing that's sure volatility?
Volatility, I expect to remain elevated, at least in the near term, through the next quarter or so. Let's hope in the second half of the year, David, it comes down a bit.
Yeah, the year so far has been quite a wild ride. I think we can all agree on that. Many thanks now to Kate Moore of BlackRock and Rebecca Patterson of Bridgewater Associates, Director of Investment Research. Coming up, Deborah Lehr of the Paulson Institute on the China piece of the puzzle. That's coming up next on Wall Street Week, and we are on Bloomberg. China
It's been the economic success story of the last half century, as GDP and per capita GDP have gone up faster than any economy in history. But now some people see some problems developing, whether it's the struggling property sector, flagged by investors like George Soros.
China is facing an economic crisis centered on the real estate market, which has been the main engine of growth ever since Xi Jinping came to power.
Or the policy of zero tolerance for COVID that experts like Amish Adalja of Johns Hopkins find just plain wrong.
COVID zero was wrong from the beginning. If someone wrote that on an essay question on a test, I would say that's a wrong answer to how you deal with this type of a virus.
Factors that lead our special Wall Street Week contributor Larry Summers to suggest we may be overestimating China's economic strength and underestimating its problems.
Consider the possibility that we may be underestimating China's challenges now, and we need to be particularly careful about being overly provocative to them.
And for more on China, we're going to turn now to, I'll call her our resident expert on China. She's Deborah Lehr. She is the CEO of Edelman Global Advisory, as well as the executive director of the Paulson Institute. Welcome back to Wall Street Week. Good to have you here.
Very delighted.
So you understand President Xi and China better than most Americans do. Give us a sense of how he looks at this year going into 2022.
Well, this is a really important year for Xi Jinping for many different reasons. He started his reselection campaign leading up to a potential third term as president. He is still managing the economy coming out of COVID. He is facing the big question of how to reopen after this zero tolerance policy and COVID lockdown. And now his new friend, Vladimir Putin, has put him in a very difficult position as he has to choose between the relationship with Russia and the relationship still with the West, and particularly the United States.
So what about that relationship? We saw the two of them together at the beginning of the Winter Olympics, sort of pledging their troth, if I can put it that way. They're really supporting one another. At the same time, often people who are autocratic don't like violations of boundaries. And now we have Russia invading Ukraine. What is China's position here? And to what extent will they help Russia out by buying things like oil and wheat?
Great. Well, you know, it's, I guess, a certain irony that it's the 50th year to celebrate Nixon's kind of visit to China and the reopening of the relationship, which was really driven as a way to counterbalance Russia. And we're now back in looking at this triangle. Russia's move has put Xi Jinping in a very difficult position because traditionally the Chinese position is not to violate national sovereignty. On the other hand, Vladimir Putin is making certain arguments about a historical legacy that resonate for China when it comes to its position on Taiwan. But China is still very dependent on the West. Looking ahead at the economy, you know, we've talked a lot and there's been a lot of discussion about what the impact of COVID and the lockdown has been on the Chinese economy.
What has it been? Has it really hurt them badly?
Well, as we've looked really at some of the fundamentals, not as much as you would be led to believe. That the real drags on the economy have been a tight monetary policy. They have been the lack of semiconductor chips because of U.S. sanctions and the energy shortage. Xi has been starting to address all of that. They're looking at ramping up monetary policy with a stimulus program in this first quarter because that will start to hit come October, November, just as he is standing for his reselection. But also he's been addressing the energy shortage. Looking at what's going to happen with Russia, China just signed long-term contracts when Vladimir Putin was there in early February at the start of the Olympics for wheat, where Russia and the Ukraine are some of the largest growers, and for oil. But if the oil prices go up to, you know, they're already hitting 100, 150, people are speculating even 200, this is going to have a significant impact on the Chinese economy and their ability to maintain even what we speculate will be a 5% goal of growth this year.
What about the growth level? Because China has really been an engine for growth globally, not just within China, but globally. It is slowing down some. How badly is it slowing down?
Well, if you look at last year and you talk about the effect of COVID, putting aside kind of these talks of the lockdown and the supply chain, if you look at the numbers, it's unbelievable. They had an absolute banner year when it came to production and when it came to exports. So the supply chain kind of holdups weren't necessarily from China, except in some isolated cases when they did close down a port for a COVID scare or something like that. They really were an engine of growth with the rest of the world. Now, this is going to be a supply shock to the rest of the world, and what Russia has done is going to have an impact on global growth, and that is definitely going to hit China because they still are dependent on these export markets. The other area that we see it having an impact has been on consumption. Unlike in the West, where we saw a lot of consumption for goods, in China we didn't see the same thing, and we didn't see a big move to e-commerce. The concern both about the reopening and the concerns of people getting COVID, but the reopening of China, I mean, but also of now this shock to the system for Russia is that the Chinese are going to continue to save, and that's going to be a further dampening on consumption, which the Chinese had been hoping was going to be one of their big drivers of economic growth.
Before we had the Russian invasion of Ukraine, a lot of concerns about China, at least from the West, were about their property market. That really, that is really suffering, as we know, starting with Evergreen, but it's gone well beyond that to a lot of companies that we thought were in good shape. How bad a problem is that for President Xi?
Well, certainly the property market was a drag on the economy last year. There's absolutely no question, and it still remains a significant part. But recent research done by the Paulson Institute shows that in many cases, we believe that property sales numbers were actually inflated and probably up to 15 to 20%. So that has an impact on what the percentage is of the property market in terms of economic growth. Where we do see it having an impact, though, is on land sales. And land sales traditionally in the provinces has been how governors or even how mayors have raised money to meet a lot of their social needs. And that now is not going to be a source of revenue, and we're going to see continuing debt in both in the cities and in the provinces is an issue that she is going to have to deal with.
What about the fiscal shape of the cities and the provinces? I have seen some reporting that says, looking forward to 2022, it might be a rough year for them. And it raises the broader question of, we think of President Xi in charge of the whole country. Right. There's a lot of other people and institutions below him that can put pressure on him.
Absolutely. And you think about these governors, I mean, many of them are heads of provinces that are larger than most countries. And so what they're dealing with 100, 200 million people is really significant. And with the revenues coming in, one of the things that she has done is centralized a lot of the revenues, and they give back a certain percentage to the municipalities and the provinces, but they have a large number of unfunded mandates. We're also seeing a huge shift in the population as people are allowed to travel more and go to the cities where there is economic opportunity. In those cities, the property markets will do well. It's going to be in those provinces, which are traditionally the poorer provinces also, where we're going to see the challenges to the property market, but also these inabilities to meet these unfunded mandates and significant debt issues arising.
So, Deborah, as you know so well, in the United States, it's been thought every 4 years is sort of a good year to invest because in a presidential election, they'll figure out a way for it to get going.
Right.
Is that true this year for President Xi, given what he has coming up toward the end of the year? What does that mean he can do to really stimulate the economy, to make sure investment looks good, particularly for investors into China?
Well, certainly one of his campaign slogans, I'm sure, is stability. And that's what he wants to see this year. What's happening with Russia is going to have an impact on that, but I think China is going to do whatever they can, and certainly the leadership there, to try and create stability, whether it's economic, whether it's political, whether it's social, whether it's related to climate.
We're talking about social stability. It's perceived, at least in the West, that there's been a little bit of a deal between the government on the one hand and the people on the other, that the government will have more leeway to do what it wants, but it will deliver prosperity to the people. Is that under some pressure now in China?
Well, certainly with the Chinese people, there was always a hope that the economy would continue to grow and an expectation that jobs would be created for the new college graduates and that life would continue to improve. As there is these hits to the economy, as we're looking at challenges around climate change, as we see what's happening with Russia, I do think these are issues that are going to have an impact. The real test is going to be as China starts to reopen to the rest of the world and what happens and how they start to address COVID when they move from a zero tolerance policy.
And as you say, this year is particularly important to President Xi given the plenum. do we have any sense of when that plenum is going to be?
Well, the dates don't usually get released until a little while beforehand, but traditionally they're usually around late October, early November.
Okay, thank you so much, Deborah. That's Deborah Lehr of the Paulson Institute. Coming up, we wrap up the week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we're joined once again by our very special contributor for Wall Street Week. He is Dr. Larry Summers of Harvard. So, Larry, it's good to see you again. This has been a rough week, I think it's fair to say. The big event of the week was that full-scale invasion, the likes of which we haven't seen since World War II, of Russia into Ukraine. What are your thoughts overall on what we've seen this week?
From the perspective of 6 months ago, this is a shock. From the perspective of what had been unfolding and what U.S. intelligence had been telling us, it wasn't that surprising when it came. But make no mistake, I think there's a real chance that this is going to be one of those moments like January 6th, like 9/11, like November 22nd, that echoes through history. That this kind of naked aggression could take place in Europe, that there could be the kind of emerging alliance that we have seen between Russia and China at the same time, means that we are in a very different world than many of us had thought we were headed into. The United States faces far graver challenges to its security than anyone would have thought likely even several years ago. And that's going to have ramifications, or needs to have ramifications, for almost every aspect of our national life. History has not ended. We are engaged in the kind of struggle that Lincoln spoke of, about whether government by the people, for the people, can long endure. That is a challenge domestically. That is a challenge globally. And anyone who thinks that it is not a challenge to their ability to flourish and profit as a business is making an enormous mistake. Because if we lose this struggle, it is not only our freedom and our security, but our prosperity that will be at peril.
The thoughts of all of us, I'm sure, are first with the men, women, and yes, children in Ukraine and what they are going through right now. And also the issues of the world order that you're raising, which are very profound. At the same time, this could have as well some profound economic consequences, particularly in a world, in the United States particularly, where we have a fair amount of inflation. What do you think the economic implications of this geopolitical crisis could be?
David, it's not going to be good. The direction is stagflationary. The direction is both to raise prices. We're seeing that in oil and energy and other commodity markets. The direction is also to reduce the level of demand and spending as those price increases sap purchasing power. So the very difficult job that the Fed had already made for itself by falling so far behind the curve has become that much more difficult with what we have seen. The danger is that team transitory will morph into team, it's a supply shock caused by oil, and find further excuse to avoid taking the necessary steps to contain inflation, and therefore postpone the ultimate reckoning and make more serious what needs to be done to contain inflation. The argument will be made that we can't afford restrictive policies. The problem is that we also can't afford an entirely unsustainable economic path that will ultimately set the stage for more economic distress, more pain, and more reduction in employment for the most vulnerable people in our society. This is a very serious moment, and it's a moment when policymakers have great responsibility to do things that are not easy.
Larry, I don't know if he's team transitory or not, but a respected economist, I know you respect him, a former classmate of yours, Paul Krugman, weighed in on the inflation question, at least one aspect of it this week in the New York Times, where he essentially, if I can summarize it, took issues with what he called sort of technocrats who were distancing themselves from the Biden administration by criticizing some of the politically popular things that have been suggested, such as, for example, suspending the tax on gasoline, something you commented on last week on this program. It got a reaction from you, I saw on Twitter.
Paul's a brilliant guy, but on this, I think he is way off base. We would not be where we are if many of the economists who saw inflationary danger last summer had been prepared to speak up and express their concerns. By giving air to the bogus view that inflation has something to do with greed, distinguished economists are delaying the moment at which it will be confronted in a serious way.
So, Larry, let's take a moment here at the end to look forward to next week. We're going to have the first real State of the Union address from President Biden on Tuesday evening. That's always an important and, yes, challenging speech for a president. It's going to be particularly so, I suspect, this year, given what you've just been saying about inflation, but also the war in Ukraine. What would you like to hear from President Biden on Tuesday?
You know, I think there are things that are more important than the usual laundry list of policy proposals. I'm hoping to see a real change in tone from the president. President Biden needs to shift from being the protect the middle class from the pandemic president to being prepare America for the struggle ahead president. We don't need a middle class foreign policy now. We need a safe and secure world policy now. We don't need efforts to provide particular tax cuts or particular benefits to particular constituencies. We need a return to the spirit of President Kennedy, who at a moment when the country was challenged, asked America not what their country could do for them, but what they could do for their country. And so I hope that President Biden will recognize the gravity of the moment, will signal the necessary pivot given what is happening in Russia, what is happening in China, what is happening to the two of them together, and what is happening to our own democracy. Our own democracy, when a former president, just 13 months out of office, is calling the leader of a country who launches a world war a genius. That is a grave threat, and it points to a kind of polarization in our society that the president needs to address.
Important moment. Well said. Thank you very much to Larry Summers of Harvard, our very special contributor here on Wall Street Week. And this is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We end with a review of what world leaders are saying about the crisis in Ukraine.
We will limit Russia's ability to do business in dollars, euros, pounds, and yen to be part of the global economy. We'll limit their ability to do that. We're going to stunt the ability to finance and grow the Russian military. We're going to impose and we're going to impair their ability to compete in high-tech 21st century economy. We've already seen the impact of our actions on Russia's currency and the ruble, which early today hit its weakest level ever in history.
Circumstances require firm and immediate actions from us. Donbass's People's Republic asked for help from Russia. I decided to conduct a special military operation. Its goal is the protection of people who, during 8 years, suffered from abuse and genocide from the Kyiv regime.
Our worst fears have now come true, and all our warnings have proved tragically accurate. President Putin of Russia has unleashed war in our European continent. He's attacked a friendly country without any provocation and without any credible excuse. Innumerable missiles and bombs have been raining down on an entirely innocent population. A vast invasion is underway by land, by sea, and by air. And this is not in the infamous phrase, some faraway country of which we know little. We have Ukrainian friends in this country, neighbors, co-workers. Ukraine is a country that for decades has enjoyed freedom and democracy and the right to choose its own destiny. We and the world cannot allow that freedom just to be snuffed out.
This morning we are defending our state by ourselves as we did yesterday. The most powerful forces in the world are watching from a distance. Have yesterday's sanctions convinced Russia? We are hearing in our sky and seeing on our land that this is not enough.
A deliberate choice was taken consciously by President Putin to launch a war when it was still possible to negotiate peace.
It sounds technical, but this is the necessary legal administrative protection so that no certification of the pipeline can take place right now. And without this certification, Nord Stream 2 cannot go into operation.
We've been transparent with the world. We've shared declassified evidence about Russia's plans and cyber attacks and false pretexts so that there could be no confusion or cover-up about what Putin was doing. Putin is the aggressor. Putin chose this war, and now he and his country will bear the consequences. Today, I'm authorizing additional strong sanctions and new limitations on what can be exported to Russia. This is going to impose severe cost on the Russian economy, both immediately and over time.
That does it for this episode of Wall Street Week on Bloomberg Television and Radio. I'm David Weston. This is Bloomberg. See you next week.